We are conditioned to view buying a house as the ultimate finish line. You work hard, you buy the property, and you are finally financially secure. But the math underneath that assumption has changed. To even enter the current market, you need to lock up upwards of $80,000 in cash for a down payment, just to secure the privilege of a 7% interest rate. Portfolio manager Ben Felix argues that a primary residence acts as a consumption asset. It is a place to live, rather than an efficient vehicle for building wealth. This diagram shows the reality of that timeline. Over 30 years, your initial down payment doesn't just sit there growing. It is actively dragged down by the unrecoverable costs of compound mortgage interest, rising property taxes, and inevitable maintenance. The trade-off is straightforward. You buy domestic stability and social status, but you actively sacrifice your liquid capital and financial flexibility for decades. Which brings us to Bahia, Brazil, a location that has evolved into a strategic hub for people looking to optimize their lifestyle and capital simultaneously. The Bahia Reboot Resort is a purpose-built regenerative sanctuary. It brings together fresh food, community, and structured silence. But from a financial perspective, it is designed entirely around fractional real estate ownership. Instead of dropping $80,000 on a domestic down payment, a $12,000 entry point buys a formalized 1/5 fractional share of a specific eco-luxury hospitality asset. This split-screen flowchart illustrates the pivot. You are deploying a much smaller amount of capital into an asset that actively flows cash back to you, rather than draining it. But to make this work, you have to accept a very specific trade-off. You must decouple your life. You rent your primary residence domestically to maintain flexibility, and you hold your real estate equity abroad. Let's compare the exact mechanics of these two paths side by side. This comparison matrix breaks down the first hurdle, entry cost and carry debt. Early investors secure their share at $12,000. That isn't a timeshare fee. It confers real, transferable equity in the chalet. You aren't locked into just 1/5 either. You can scale your position, purchasing up to a 1/3 share of the $60,000 total asset value. As the investor pool per chalet shrinks from 5 down to 3, your personal share of the profit scales up, and your personal time on the property increases up to 17 weeks a year. You eliminate mortgage interest drag entirely. In exchange, you give up absolute autonomy. You are co-owning an asset alongside up to 4 other investors. The next metric is the physical upkeep of the asset. Unpredictable, do-it-yourself maintenance is the silent killer of traditional real estate ROI. These chalets are engineered for tropical resilience. They use high-performance envelopes, elevated foundations, and multi-slope ceramic roofs, specifically designed to minimize degradation over decades. More importantly, every aspect of physical maintenance and guest turnover is handled by the resort's centralized ecosystem management. You never get a call about a broken pipe. You are completely freed from managing contractors and fixing roofs yourself. The trade-off here is control. You must trust a third-party operator to manage those operational expenses efficiently. The final metric is how the asset actually generates cash. Targeting 65% occupancy at a $180 daily rate yields $6,400 in annual net income per investor. After operational expenses, that's a 10.7% return on investment, distributing roughly $530 in monthly passive income. We have to address the logistical friction. Buying property as a foreigner in Brazil usually requires navigating local bureaucracy and acquiring a Brazilian tax ID. The Bahia Reboot model bypasses this. You purchase a formalized sectional title from an entity that manages the property on Brazilian land. You secure the legal equity without ever needing to register for a local tax ID. This offers an incredibly streamlined entry. However, it introduces a layer of abstraction. Holding a share through a management entity is functionally different than holding a deed in your local county courthouse. This quadrant chart maps out exactly where these assets sit. The traditional home buyer lives in the top right. They have high capital to deploy, and they demand total dominion over their property. The fractional investor sits in stark contrast. They deploy far less upfront capital and accept shared control in exchange for yield and flexibility. You have to respect the physical limitations of the design. These chalets are intimate, biophilic sanctuaries built for 10 to 17 weeks of rotating personal use. If you need a permanent 365-day shelter to raise a family and anchor yourself to a specific school district, this model will mathematically fail you. Bahia Reboot is strictly an alternative investment and a lifestyle asset. It should never be purchased to replace full-time domestic shelter. This asset is built for the frustrated saver and the remote optimizer. It is for the person looking to deploy $12,000 to $20,000 into a hard asset without becoming geographically anchored by debt. This is a direct acquisition of equity in a living ecosystem, a sanctuary designed to support rest and nature immersion while providing immediate returns. By bypassing the traditional housing trap, you trade the absolute dominion of a suburban home for financial freedom, passive quarterly cash flow, and co-stewardship of a regenerative sanctuary.